Hi, this is Shade with Tax Sale Support with another video in our YouTube training series, Tax Sale Fundamentals. So for this video, I wanted to talk about the three property tax systems, the tax enforcement systems, but specifically we wanted to talk about tax liens. So to really talk about tax liens and the other systems that are involved, we need to address the issue of state laws and make sure that everybody understands that each state has its own set of state laws that are completely unique to that state. And those state laws govern the taxation of property, among many other things. Federal laws cover things like our income tax, Social Security, and the laws have to be written so that the government has the permission essentially to do that. Now, with state laws, they can also take an income tax there, but it's a lot of that is about the property tax itself. However, the state government is not the one to collect the property tax. That is something that's done on a local level. So, something else to think about is part of the reason why tax liens have never been more in the mainstream in terms of investments, and that's because people didn't really understand the way that the systems worked because you had 50 different states that all had their own unique system in a way. What we did was we attempted to simplify the systems by trying to narrow them down, and we were able to narrow those down to three specific systems that are used throughout the United States. So, those three property tax enforcement methods are tax liens, tax deeds, and redemption deeds. Now, this is a breakout of the map and how the states are split up according to liens deeds and redemption deeds. The states that you see in yellow are the redemption deed states. The red are tax deed states, and the green are tax lien states. Now, the blue are states that utilize both tax liens and tax deeds, which is actually something that we're seeing more common now than before. Even states in tax lien states that have never traditionally dealt with foreclosures much in the past are now beginning to foreclose on property and offer them at sales. So we're seeing even tax lien states that offer up property as well. Now, what exactly is a tax lien? Let's go over the legal, let's go over a definition of it first, and then let's talk about how exactly it works. So, a tax lien is a legal claim that's placed against real property due to delinquent property taxes. Now, it's usually placed there by the local government. That's normally a county, unless we're dealing with a different part of the country that might use boroughs or something like that. Now, the lien prevents the transfer of ownership. So that's a big important point right there. You cannot transfer ownership as long as that lien is placed against the property. And it utilizes that property as security for an unpaid debt, which in this case is the delinquent taxes that are owed. Now, tax liens are first position liens, and they can be used to foreclose on property after a set redemption period has expired. So they have a tremendous amount of power. They can actually be used to foreclose on the property after that time period has passed. Now, to give you a little bit better idea of about how that works, let's think about the way that most local governments operate. Most local governments provide a number of services to the residents within the community. Some of those services include things like public education, police and fire, the county services themselves, sometimes construction. There are so many different things that counties provide, and they rely on property taxes as their primary source of revenue from the community at large. So the county, they need an enforcement system in place to ensure that people pay their property taxes, because the reality of it is, if there wasn't some kind of a penalty, if there wasn't consequence for not paying property taxes, nobody would do it. So tax liens are an enforcement method, and they are one of those three. And the idea behind it is quite simple. When somebody's late with their property taxes, the county places a lien against their property for the amount that they are delinquent. So it could be generally the amount of the property taxes annually plus any penalties or fees that have come up. Now, the county has no interest in the property itself. They really only have interest in collecting the money that's owed to them, and that's their purpose actually in creating the lien. So when the county places that lien against the property, the owner is unable to sell the property and a redemption period begins. Now, they can range depending on where you're at. In this example, we're saying 2 years, but redemption periods can be as long as 4 years or as short as 6 months in some cases. So that redemption period is important because it represents the time period in which the property owner can rest assured that they're not going to lose their property to foreclosure. Also, remember that tax liens are meant to redeem. That's how they're designed, and the vast majority of those do redeem. So the idea for the county, though, is if they can create this tax lien, then it gives them something that they can sell to investors, which is actually the way that it's written out in state law. The idea behind this is that the county creates liens, places them against properties, and then holds a public tax sale where they can sell these liens to local investors. Now, the reason why investors buy these liens is because, first off, they're secured by real estate. The lien is secured by the entire piece of property. And in addition to that, they also pay out a high interest rate return. So every state that utilizes liens also sets out a maximum rate of return that you can earn in that state, but those range anywhere from 12 to 24%. So in this example, we're saying 18% in a 2-year redemption period. But again, the primary purpose in creating that is so that the county can sell this at the tax sale. And when they sell this at the tax sale, they have immediately collected that money that's owed to them without the property owner needing to come up with it. So it is a solution in that way. So really what it does for them is it enables them to collect that delinquent amount right away. And that's important considering some of the ongoing funding they have for various things. So on the day of the sale, there are two things that happen that are important for you to realize. The first is the lien begins accruing interest. Okay, and in this case, 18% annually would be 1.5% per month. So it begins to accrue at a rate of 1.5% per month. Now, the second is that the redemption period begins. So if it's a 2-year redemption period, then that begins on the date of the sale. And that actually begins on the date of the sale, whether the tax lien sells or not at auction. Now, that's important because there are only two possible outcomes for tax liens when you invest in them. They are incredibly simple, and the outcome depends completely upon the property owner and what they do. Now, the vast majority of the time, what happens? Somebody eventually comes up with the money to pay off the taxes. And so when they do this, when they pay the county in full, the lien is removed and the county will send a check to the investor for their initial investment plus the interest that they've earned up to that point. Now, the second option is what happens if the redemption period comes to an end. So if that 2-year time period comes to an end and the lien still hasn't redeemed, then that tax lien can be utilized to initiate foreclosure on that property. Now, even once foreclosure is initiated, essentially what that is really all about is giving the legal owners the opportunity to retain their property. And so it's simply letting them know the amount that's owed, the date, and the consequences if they don't pay it, which is essentially losing the property. So oftentimes, properties liens will redeem once that has been initiated. But if they don't, then you foreclose on the property and become the new property owner. At which point you can decide what you'd like to do with the property, whether you want to sell it, rent it, maybe you offer something like owner financing on it, because you will have paid a very small amount for this tax lien. So For those states around the country that utilize tax liens, they represent an incredible opportunity for investors to earn high interest rate returns on a very safe investment, and they're quite simple. If you think about this, if the objective for tax liens is for them to redeem, then what you're really after when you're looking for tax liens is tax liens that have been placed against properties that are valuable, properties that have use. Any property that somebody doesn't want to lose to foreclosure is a sure bet to be a great tax lien because it means that it's going to redeem. So, and if it didn't, when you pick out a property like that, it would be well worth foreclosing on because you would earn, make so much profit on it. So, it is an incredibly simple investment and a very easy way to earn a high interest rate return. Now, if you enjoyed these videos, or if you'd like more information, you can go to our website to get your free ebook, secretsoftaxlieninvesting.com. Or you can also visit our membership site where we have tax sale lists and training and a lot more than that at taxsalesupport.com. So thank you for watching, and please remember to subscribe.